Hi, I'm Carmen Campagnaro from ProFunds Mortgages, president and founder, also of District Property Trust and Valor Group of Companies. I'm here today with Carl Gomez. Thank you so much for joining me. Carl Gomez is a chief economist. He's worked with CMHC, with RBC, TD Bank, specifically in real estate. And I thought, what a great time for you to come on and share some knowledge and wisdom with our investors who are probably in panic mode right now with this pandemic going on. I will say that we've been open for business. We're open for business. I'm not feeling panicked. But Carl, I want to share with our investors and our clients, some insight, because everybody probably wishes they have someone like yourself that's really sophisticated in real estate and an economist that can help us understand what's happening right now and what's going to happen, and put some of our minds at ease that it's not doomsday, but also bring some reality to people and let them know what's happening with respect to the real estate market in Canada.
Well, first, thanks for having me very much, Carmen. Absolutely unprecedented times in terms of what's going on. Obviously, this virus has created a complete and total shutdown of the economy as everybody is social distancing. The point I want to make is that this is not just about Canada, it's about the globe. I mean, this is happening across the world. And when you have this complete and total shutdown of the economy, obviously economic growth comes to a standstill. And we've seen growth come to standstill in key sectors like food services, restaurants, hospitality, a number of different social sectors. But the good news is, the economy is still working in other sides of the market. You and I are working from, places that are pretty comfortable. I'm working from home. The point being is that, the world is getting by and we're coping with a tough time. And, certainly the governments are much more responsive. Just today, the Bank of Canada came out with some more stimulus measures, including quantitative easing to keep the capital markets going. So, while these are unprecedented times and while we will probably see an unprecedented hit to GDP and to growth, we are getting by. And, that's a positive scenario in all of this kind of doom and gloom that we're seeing right now.
I just want to also let our investors know that, we're here business as usual. Not as usual, really, because half of our team is out of the office, but we are working. We are getting commercial financing right now, residential mortgages, private money is a big thing for us right now. But what do you see happening in the next, let's say, up until December 31st, 2020?
Well, I think, the key point is that a lot of what's going to happen, it takes its cue from policy from the medical side of the world. The global pandemic crisis is a medical crisis, and government officials and everybody else are taking their cue from that. If we look at the whole concept of what we're doing with social distancing, it's all about flattening the curve in terms of infection. And, fortunately, in some parts of Canada and some parts of the US as well, we're actually starting to see that curve flattening happen. In BC, in Alberta, the rate of infections is not doubling every couple of days. It's starting to slow down. So that's good news. It still hasn't happened in Ontario and Quebec. But when you were saying read the news headlines and you hear about deaths and infections, but there are very concentrated infections happening in certain parts of the economy. And some of that is think about old age homes and retirement homes, some different centers like that. So the infections are happening. But as far as, where I see these impacts happening is, the economy can't come back online till the government officials and medical officials say it's time that we can kind of ease back on our social distancing. So, Premier Ford has said that, social distancing in Ontario will continue for another 28 days or so. And then at that time, we'll probably start to see some letting up of services and stores and things to start opening. So, it's probably not going to be, a couple of days. It's probably going to be a few more weeks where we continue to see that. But the good news is if we continue to move along that path, then, the sooner we can actually get back to some semblance of normal. I wouldn't say exactly normal like what it was, before this pandemic crisis started, but at least some semblance of normal where people can start getting together and businesses can start to reopen.
Mm-hmm. Now, how do you feel that this would impact our real estate market?
Well, it's interesting because as you mentioned earlier, Canada's real estate market has been doing splendidly going into this crisis.
Yeah.
And so, the way I look at it as an economist is that the fundamentals were very sound going into that. And that's good because that's why you want strong fundamentals, because when bad things happen, and this is one of them, you have fundamentals to lean on. So, just in terms of some of the data points that I've seen coming in, one of the things I've noticed in the residential markets is that 85% of the tenant base in residential real estate, the apartments, were actually able to make their rent payments in April. We don't know where they're going to be in May. Certainly the unemployment rate's gone up, and many people who are tenants tend to work in service sector jobs. So, there may be a risk of a little bit of that cash flow being, stopped by people not making their rent. But the good news is most landlords are working with their tenants. And where I see this as a positive is that it brings the landlord and the tenants closer together. So I think that's going to be an interesting sort of development as we go forward in this sort of situation. Yeah.
I have that could be a whole nother discussion.
For sure.
Ultimately, we had good success with April collections. We'll see what May is like, as we have quite a bit of multi-residential real estate, and but it has been okay. It hasn't been that horrible, but let's pray for May to be as good as it was in April.
And the good news there too is that the government has stepped up. I mean, both in provincially and also federally, to kick in some stimulus to assist that part of the economy with cash infusions. So helping businesses with cash lines, helping workers on the front lines with wage subsidies and things like that. That's going to help in the near term. So hopefully, April was a pretty good month for collecting on rent, and hopefully we see the same thing in May as the government helps out in those transactions.
Yeah. Exactly, that's great. Now, what are your thoughts on, now I know everyone's going to has so many questions for you, and me myself as well, like what do you think is going to happen to the real estate values? Like, are we going to see a huge decline? Is it going to be different from a commercial property to a multi-residential property to a single family home or a condo?
Yeah.
Can you share some input there, or advice or knowledge?
Sure. Well, I will say, going into a downturn like this, every asset value is going to be impacted. We always see it in the stock markets first, and certainly the stock market has shown that equity prices have come off their highs, and certainly they were at their highs. So, there's no doubt that when things slow down, they have to come off. I do think for real estate, there always is a bit of a lag between real estate and equity prices to adjust. And, one leading indicator of where things go is the REIT sector. And the REIT sector has seen their values come off. But now suddenly a lot of people are saying, well, there's a lot of value there still with the REITs, because the yield on a lot of these REITs is pretty good from a real estate standpoint. Mm-hmm. And so, I come back to this point that as long as there's security of income that's there, there is reason to support some of the values that are there as well. So I think for commercial real estate, income producing real estate, if you have, fairly good cash flowing properties and good sound tenancies that continue to be able to pay their rent, the value should hold up relatively well. Where I get a little bit concerned is the near-term impact of residential real estate when suddenly you have people not listing homes, sales slow because you can't go and visit homes, things like that. Mm-hmm. There's certainly a little bit of froth in some of the market as well. And so if we think about the near term, a dive in sales activity simply because people can't see properties and people aren't listing, that may have an implication a little bit on the pricing that comes out, because I think the only people that are going to be pricing or putting things on the market right now is a little bit more distressed properties. So you have a little bit of that sort of opportunity, not to turn lemons into lemonade, but there is an opportunity here to start looking for distress in a market like that.
Yeah, so. I know it's unfortunate, but that is the truth, right? But
right.
And going back to you speaking about the REITs, we have a REIT, District Property Trust. That's a private REIT, right. And I wanted to ask you, what is the difference between the public markets and the private markets with something like this happening in our economy?
Well, I think the one difference when you go from public or from private to public is that the public markets trade every day. And a lot of times what I say is that some public REITs are real estate wrapped up in a stock market wrapper. So fundamentally what you have is real estate, but the valuation or the pricing of that stock is really determinant on what the market is thinking. And there's a lot of noise in the market. There's a lot of fear in the market. And so there's a lot more volatility that comes out in the pricing. Private markets, private REITs, private real estate tends to be a lot more stable. And we saw that through the financial crisis. We've seen that through various downturns. So private real estate, for lack of a better word, tends to be a little bit more sensible. It's not erratic. It doesn't tend to be as subject to fear as the public markets do.
Exactly. And, that's what I was thinking earlier when you were saying that REITs, income producing properties, as long as they have cash flow. And my experience in the industry, and again, I don't want to make this all to be perfect because it's not. I mean, it's a horrible situation we're in and it's terrible times. But I mean, I've been through the 1990 kind of crash. I don't even want to say that because everyone knows how old I am. And
I was there too.
and then again in 2007 and 8. And I'll tell you, the income producing properties were solid. They maintain their value. People need a place to live, obviously. Mm-hmm. And rental properties, as far as I'm concerned, seem somewhat recession proof. And I have to be careful how I say that, but it's mm-hmm. true. So that's a great thing. So if you're in bricks and mortar, multi-residential, commercial, that type of thing that has good solid tenants, we have medical plazas and they're all paying their rent. I guess these doctors need to be there for their people, right? So
yeah, absolutely.
It's a great time in that respect with having security there. So we discussed then what your thoughts are on the real estate values. What markets are going to be negatively impacted here?
Well, I think, when you think about who's not paying their rent, and who's having difficulty doing that, well, certainly there are a number of restaurants, retailers, groups like that are just shut off. And if you look at the profit margins in some of the small businesses that are out there, some of the retailers, they were pretty thin to begin with. So, if I'd say, it's pretty clear that the one sector that's going to really feel the impact of this from a bricks and mortar perspective is retail. Mm-hmm. And I'm not talking about essential services retail because the grocers and the liquor stores are all doing very well.
Yeah.
Very well. I was just there myself yesterday. But for discretionary shopping, non-essential retail, I think there's going to be some vast changes that are going to have to happen in that space. It's accelerating some of the trends to online that was stealing away sales from retail, bricks and mortar retail. And I think we're going to be in a deeper sort of impact there. Again, to turn lemons into lemonade, certainly when you look at the valuations for retail and even from some of the REITs that are in retail, they've really been hit hard. So, it's, you want to go on a contrarian basis and look for opportunity. There's, definitely opportunities in that space if you've got very strong conviction and a will of steel to go into that space.
Yeah. Well, and like you said earlier as well, now is an opportunity. If prices do go down or if anything is up for sale currently, it's probably because they have to sell and it might be a great opportunity. So it's a good time to invest in that space as well.
Yeah.
Now, what are your thoughts on when do you see this changing and getting back to normal, or will it ever?
Well, that's a great question. And I spend a lot of late nights reading a lot of the literature that's out there about that question. And I think, early days, when this first started about a month ago, a lot of people assumed that there would be a kind of a V-shaped recovery, that, the activity in the second quarter, third quarter would come booming right back as we return back to normal. But I think the reality is, when you look at it from the medical side taking the lead, is that social distancing needs to continue, and it needs to continue whether it's in a strong form right now or some sort of constrained form going forward until there is a vaccine. And from what I've been reading, the vaccine is probably about 12 months out. So, once we get to that stage, 12 months out, if we get to that vaccine, then we probably return back to a state of normal. But what I've also been reading is that, when you go through pandemics, historically, going back, way back, hundreds of years, The world comes out a little differently because institutions change, things change. One of the things that I read recently that the Federal Reserve talked about is the fact that interest rates stay lower for a lot longer after pandemics. So, when you think about it from a real estate perspective, while we might see some near-term noise in terms of mortgage rates going up as banks hoard capital and stuff like that, I think long-term we are going to continue to see these interest rates that have been historically low remain low for a long period of time. So that that's one thing. The other interesting avenue is the focus on the medical infrastructure. You're talking about medical office buildings and things like that. That's a side of the economy that's been underinvested, and I think our reaction to this pandemic has kind of shown us that. And so I think long term, in terms of normal, there's going to be a lot more investment dollars and capital going to that side of the economy. From an investor standpoint, then you think about those sort of things as being opportunities, because there's going to be much more growth in those sectors as capital is deployed there.
Right. Now, I hear a lot of people, doomsday, depression, Great Depression. What are your thoughts on that comment?
Well, GDP and employment are statistics. They're real to some people. I mean, certainly when you feel it, it's going to feel tough if you lose your job, if growth rates and stuff are low. From a historical perspective, if you just weigh that up, well, yeah, I mean, we're going to see growth rates and GDP numbers and unemployment rates that are probably we haven't seen since the Great Depression. So that analogy rings true. The one thing I would say is that that's where the analogy or the comparison kind of ends, because the Great Depression happened because of a lot of imbalances, problems in the economy, policy decisions, and stuff like this. This is more like a hurricane or a natural disaster event happening, and we will recover from that because the infrastructure and everything that's in the economy is a lot better. So I wouldn't call it a Great Depression. But I do think what we will see is some profound secular changes that happen as a result of this. And like the Great Depression, like other big natural disasters, change has to happen. And so I think as investors, as people who are working on that side of the spectrum, we have to embrace those changes and work with them and not expect things to go back to exactly the way they were before all of this. And that's key. Yeah.
Yeah. A lot of people, well, nobody likes change, right? It was
Yeah.
humming along there. And,
Yeah.
2020 started out so great, and then all of this took place. So I just wanted to ensure our investors, or let our investors know that, we're on this. Our company's still moving forward aggressively. Our construction projects are still underway. The only projects that they really did shut down temporarily were the ones that really haven't started yet.
Right,
But
new projects.
So we're moving ahead there. In my experience in a situation like this, in a market like this, is that private money is huge and high in demand.
Yeah.
Now, I know people are saying, oh, banks aren't lending like these. They're just taking longer, but they are lending.
Well, and to that point, I think one of the things that's very interesting and different than the Great Depression, as we were talking about, is we had a liquidity trap in the Great Depression, that central banks and monetary officials didn't open up liquidity for the economy, which took a reason why the Great Depression was so long. It took a long time for things to come back. The difference today is you can see the Bank of Canada, you can see the Federal Reserve, you can see the monetary officials acting in a way to keep liquidity in the system. So by buying bonds, by lowering interest rates, that's going to free up the system. And that's the positive. So we may not see it in the near term because, to use an analogy, pipe has to unfreeze. But once it melts and unfreezes because of the actions that the central banks are doing, that money will start to flow. So, from my perspective, I think there's a lot of capital that's still out there. The money is still out there, and that's supportive to asset values in the long run. In the near term, we may see some dislocations here or there. And again, I think that's where, from an investment standpoint, there's opportunities to be made because there are people with capital that can bridge that gap and take advantage of those opportunities.
Yeah, absolutely. Like currently, I've been working with private lenders. There's a higher demand of people looking for funding, but if you're conservative on the way you lend in mortgage investments, say, instead of going 85, you go 75.
Sure.
And you get a current market appraisal. and things like that. People can still make excellent returns in this market with private lending, and people shouldn't be fearful of that, because a lot of our clients, some, not all, a few of our clients are saying, oh, I'm not sure, I'm afraid. So that's why I still wanted to have something like this, and something with your expertise and knowledge to share what's happening behind the scenes, and really what we're looking at.
Yeah, absolutely. And I think to your point, you really have to have conviction. Investing is all about conviction and seeing through the noise. And if you can do that, and you can take advantage of where there is dislocation and fear, certainly there's opportunities to be made. And I think that's the key, is just, not to succumb to fear, because if you do succumb to fear, then, there's nothing left to do but recoil and sit in a bomb shelter. So,
Oh, I know.
yeah.
That's so funny, but yeah, it's so true. And many people, though, are fearful. They're crippled by fear, and they don't move ahead, and then they lose a year because it's not time yet. But we're here to make sure that we have good investments there, and our projects are still proceeding, and we're still in business. Things are still going here, and we're busy. I'm as busy now as I was in February. So it's all
the world may have changed a little bit, but not too much on that respect, right?
No,
So yeah.
People are looking for mortgages. Banks are up and running. Yeah, it's taking some extra time, but it's not too bad. So
That's good.
Is there any other last minute thoughts that we could share to our clients, our investors, that you think might be important?
Well, and I always say this: real estate is a long-term investment. It's an investment that's based off sound cash flows. It's not hype usually. It's not .com stocks that are being chased with air. This is all about real, tangible cash flow investments. And I think if you think about it from that perspective, it should be far more stable than any other investment that you're going to make, provided that you do your homework, and provided that you do your due diligence around that sort of thing. It'll prove itself out. I mean, from my perspective, in my career as an economist and working with investors, both institutionally and private, diversification into real estate has always been there, because it provides the stability in a portfolio that you need for exactly periods like today, where you have massive downturns in all other asset classes. Real estate is that diversifier that helps get you through these sort of situations. So here it is, we're in that situation. Let it prove itself out, but do your homework and think about the long term.
Yeah. I'm so happy I'm in real estate. I don't invest in the stock market. I don't have any stocks. It's always been real estate, bricks and mortar for me. And this is exactly when you can say, see, brick and mortar.
Exactly.
So thank you so much. And I really appreciate your time. And I can't wait to share this with our viewers and with our clients and investors. And stay healthy, stay well, and we'll talk soon.
You too, Carmen. Thanks very much. Stay healthy and safe.